During the first quarter of this year, bonds have done much better than people expected as bond yields have declined slightly so far this year. And equities have been a bit disappointing, with most people being optimistic for equities as we entered the year. I think the main themes that have driven those market movements has been weaker data out of the US, which we think is largely weather related and will pick up in the subsequent quarters. Concerns in emerging markets over both China, where growth is slowing and where they're dealing with some risks within the financial sector, but then also other emerging markets dubbed the Fragile Five, where currencies have been under pressure as a result of some structural issues. So we think many of these problems so far in the first quarter are going to alleviate themselves as we go through the remainder of the year. So we expect US growth to pick up. We think, as I say, that the weather was impacting first quarter growth, and we should see quite a strong bounce back through the remaining quarters of the year. So the global economy should recover. Europe is doing better as well. So Europe is going from recession last year to growth this year. And while there are risks in China, we think that China can sustain growth in the region of 7 to 7.5% this year. If our view on US and global growth is correct, then what we expect to happen is that the Federal Reserve will wind down its QE program by the fourth quarter of this year. Then as we move into 2015, interest rates are going to be on the horizon, and we expect both the Federal Reserve and the Bank of England to start to raise interest rates in the second quarter next year. So these macro views are reflected in our current asset allocation stance by a preference for equities over bonds currently. So we think the equity underperformance in the first quarter versus bonds will be reversed through the rest of the year. So we have a small overweight position in equities. We are underweight government bonds and investment-grade corporate bonds because we think interest rates rises are on the horizon, and so yields should rise in advance of that. And we have an overweight in high-yield bonds, which have done very well, but we still think there's some potential for further returns there. Well, the core principles and ethos, if you like, of our multi-asset funds remains the same, and that is to deliver a steady return through the different market cycles and different market conditions, and hopefully generate positive returns over the cycle with less volatility than you would get investing in a single asset class. And we aim to continue to do that in the future, as we have done in the past.